Welcome back to Finance Kida. Today we're focusing on a hot topic that's gaining a lot of traction in the finance world, private equity fund accounting. If you've been following our channel, you know we've tackled various interview questions across different finance roles, and now it's time to shine a light on this exciting area. So let's jump right in. First up, what exactly is private equity fund accounting and how does it differ from traditional corporate accounting? Well, in a nutshell, private equity fund accounting is specifically tailored to the unique structure and operations of private equity funds. Unlike traditional corporate accounting, which focuses on the financial health of a single entity, private equity accounting deals with pooled investments from multiple investors. This means that the accounting practices must account for capital contributions, distributions, and the performance of various portfolio companies. It's like juggling multiple balls at once, and each ball represents a different investment. Now, let's talk about the key financial statements used in private equity fund accounting. The primary statements you'll encounter are the statement of assets and liabilities, the statement of operations, and the statement of cash flows. The statement of assets and liabilities gives you a snapshot of the fund's financial position at a specific point in time, while the statement of operations shows the fund's performance over a period, detailing revenues and expenses. The statement of cash flows, on the other hand, tracks the flow of cash in and out of the fund, helping investors understand liquidity. These statements are crucial for investors to assess the fund's performance and make informed decisions. Moving on, can you explain the life cycle of a private equity fund? Absolutely. The life cycle of a private equity fund typically spans around 10 years and can be broken down into several phases. It starts with the fundraising phase, where the fund seeks commitments from investors. Once the capital is raised, the fund enters the investment phase, where it identifies and invests in target companies. After that, we have the value creation phase, where the fund works to improve the operations and profitability of its portfolio companies. Finally, we reach the exit phase, where the fund sells its investments, returning capital to the investors. Each of these phases has its own unique challenges and accounting considerations. Now, let's dive into a more technical aspect. How do you account for capital calls and distributions in a private equity fund? Capital calls are requests made by the fund to its investors to contribute a portion of their committed capital. When a capital call occurs, the fund records the amount as an increase in cash and a corresponding increase in the capital account of the investors. On the flip side, distributions are the returns made to investors from the fund's profits. Distributions are recorded as a reduction in cash and a decrease in the capital accounts of the investors. It's all about tracking who owes what and who's getting paid. Next, let's clarify some terminology. What's the difference between committed capital, called capital, and invested capital? Committed capital refers to the total amount that investors agree to contribute to the fund. Called capital is the portion of the committed capital that the fund has actually requested from investors through capital calls. Invested capital, on the other hand, is the amount of called capital that has been deployed into investments. It's essential to understand these distinctions, as they play a critical role in evaluating a fund's performance. Now let's tackle the internal rate of return IRR and multiple on invested capital MOIC in private equity. The IRR is a metric used to evaluate the profitability of an investment by calculating the annualized rate of return over the life of the investment. It's essentially the discount rate that makes the net present value of all cash flows equal to zero. On the other hand, MOIC measures the total value returned to investors relative to the amount invested. It's calculated by dividing the total distributions by the total invested capital. Both metrics are vital for assessing the performance of private equity investments. Speaking of performance, let's chat about management fees. What are they, and how are they accounted for in a private equity fund? Management fees are the fees charged by the fund manager for managing the fund's investments. They are typically calculated as a percentage of committed capital or net asset value and are usually charged annually. In accounting terms, management fees are recorded as an expense on the fund's income statement, reducing the overall profits available for distribution to investors. It's a necessary cost of doing business in the world of private equity. Now, how do you account for carried interest in a private equity fund? Carried interest is the share of profits that the fund manager receives as compensation for their performance, typically after a certain return threshold is met. In accounting, carried interest is recognized as a liability until it is earned, at which point it is reclassified as an expense. This can get a bit complex, but it's crucial to ensure that fund managers are incentivized to maximize returns for investors. Let's clarify the difference between carried interest and management fees. While management fees are paid regardless of fund performance, carried interest is contingent on the fund achieving certain performance benchmarks. Essentially, management fees compensate the manager for their day-to-day operations, while carried interest rewards them for successful investments. It's a win-win situation when done right. Now let's discuss unrealized gains and losses in a private equity portfolio. Unrealized gains occur when the value of an investment increases but hasn't been sold yet, while unrealized losses happen when the value decreases. In accounting, these gains and losses are recorded on the balance sheet and reflected in the net asset value of the fund. However, they don't impact the income statement until the investments are sold, which is why they're called unrealized. Investors need to keep an eye on these figures as they can significantly affect the fund's perceived performance. What about waterfall distribution structures? Can you explain how they affect the distribution of profits in a private equity fund? Sure. A waterfall distribution structure outlines how profits are distributed among investors and fund managers. It typically consists of several tiers, starting with returning the investor's capital, followed by preferred returns, and then the remaining profits are split between the investors and the fund manager. This structure is crucial because it ensures that investors receive their capital back first before the manager earns any performance fees. It's all about aligning interests and making sure everyone is on the same page. Next, let's dive into the difference between preferred return and hurdle rate in a private equity fund. A preferred return is the minimum return that investors are entitled to before the fund manager can start taking their carried interest. The hurdle rate, on the other hand, is the minimum rate of return that must be achieved before the fund manager can participate in profit sharing. In essence, the preferred return is a safety net for investors, while the hurdle rate sets the bar for performance incentives for the manager. Now, how do you account for fund expenses and allocate them to investors in a private equity fund? Fund expenses include management fees, operational costs, legal fees, and other expenses incurred during the fund's operation. These expenses are typically allocated to investors based on their proportionate share of the fund. In accounting, expenses are recorded as deductions from the fund's income, and the net income is then distributed to investors after accounting for these costs. Transparency in expense allocation is crucial for maintaining investor trust. Let's talk about the roles in a private equity fund. What's the difference between a limited partner, LP, and a general partner, GP? Limited partners are the investors who provide the capital but have limited involvement in the fund's management. They benefit from the fund's returns but are not liable for the fund's debts beyond their investment. General partners, on the other hand, manage the fund and make investment decisions. They are responsible for the fund's performance and typically contribute a small portion of the capital, but they bear unlimited liability. It's a classic case of money in, management out. Now, how are NAV, net asset value calculations done for a private equity fund? The NAV represents the total value of the fund's assets minus its liabilities. To calculate NAV, you start with the value of the portfolio companies, add any cash or cash equivalents, and subtract any outstanding liabilities or expenses. This figure is crucial for investors as it provides a snapshot of the fund's value at any given time. It's like checking your bank balance. You want to know where you stand. During a capital raise, what's the process for calculating the NAV of a private equity fund? During a capital raise, the NAV is typically calculated based on the most recent appraisal of the portfolio companies and the fund's cash position. The fund manager will assess the value of the investments, taking into account any recent market trends or changes in the portfolio. This NAV serves as a benchmark for potential investors to evaluate the fund's performance and make informed decisions about their commitments. Now, how do you account for investments in portfolio companies within a private equity fund? Investments in portfolio companies are recorded at cost initially, and any subsequent changes in value are reflected in the fund's financial statements. If the investment appreciates, it's recorded as an unrealized gain, while any depreciation is recorded as an unrealized loss. When the investment is sold, the realized gain or loss is recognized in the income statement. This process ensures that the fund's financial statements accurately reflect the performance of its investments. Let's explore the differences between primary and secondary investments in private equity. Primary investments occur when a private equity fund directly invests in a company, typically during a funding round or acquisition. Secondary investments, on the other hand, involve buying stakes in existing private equity funds or portfolio companies from other investors. Each type of investment comes with its own set of risks and rewards, and understanding these differences is crucial for making informed investment decisions. What about co-investments in a private equity fund? How do you handle accounting for these? Co-investments occur when investors contribute additional capital alongside the main fund in a specific investment. In accounting terms, co-investments are treated similarly to primary investments, with the contributions recorded at cost. The key is to ensure that the terms of the co-investment are clearly defined, including any fees or profit-sharing arrangements. Transparency is key to maintaining strong relationships with co-investors. Let's touch on fund consolidation. What is it, and how do you account for multiple funds in a private equity firm? Fund consolidation refers to the process of combining the financial statements of multiple funds managed by the same firm into a single set of statements. This process ensures that the overall performance of the firm is accurately represented. In accounting, each fund's financials are aggregated, and any inter-fund transactions are eliminated to avoid double counting. It's a complex process, but it's essential for providing a clear picture of the firm's overall performance. How do you handle currency conversions and foreign exchange risk in private equity accounting? This is a crucial question because private equity often involves international investments. You typically start by using the current exchange rates to convert foreign currency transactions into your reporting currency. It's important to keep an eye on fluctuations because they can impact your returns. To mitigate foreign exchange risk, you might consider financial instruments like forward contracts or options. This way, you can lock in exchange rates and protect your investments from unexpected swings. Next, let's talk about side letter agreements. What is a side letter agreement and how does it impact fund accounting? A side letter is a supplemental agreement between a private equity fund and a specific investor. It can provide that investor with special terms like reduced fees or additional reporting. In terms of fund accounting, you need to track these agreements carefully because they can affect the overall financial reporting and the distribution of profits. It's essential to ensure that these side letters are reflected accurately in your financial statements. Now, what are some common challenges in private equity fund accounting and how do you address them? One major challenge is managing complex fund structures and multiple investment vehicles. Each fund may have different terms, fees, and reporting requirements. To tackle this, maintaining a robust accounting system is key. You also want to stay organized by creating detailed documentation and workflows. Regular training for your team can help everyone stay updated on the latest regulations and best practices. Moving on, how do you report fair value for private equity investments under US GAAP and IFRS? This is a hot topic and the approach can differ based on the framework you're using. Under US GAAP, private equity investments are typically reported at fair value, which is determined using a market approach, income approach, or cost approach. IFRS has a similar requirement, but it emphasizes the need for observable market data when possible. It's crucial to ensure that your valuations are consistent and well documented, as this can be a significant area of scrutiny during audits. Speaking of regulations, what are the key compliance and regulatory requirements for private equity funds? Compliance is vital in the private equity world. You need to ensure that your fund adheres to the Investment Company Act, Securities Act, and various local regulations depending on where you operate. This often involves regular reporting to regulators and maintaining transparency with your investors. Staying updated on regulatory changes and ensuring your team is well informed can help you navigate this landscape smoothly. Now, let's discuss how portfolio company valuations are conducted in a private equity fund. Valuation is a critical aspect of private equity accounting. Typically, you would look at multiple methods, including discounted cash flow analysis, comparable company analysis, and precedent transactions. It's essential to apply a consistent methodology and document your assumptions. This not only helps in reporting, but also builds trust with your investors, who want to know that their investments are being valued accurately. How do you account for distributions made in the form of stock rather than cash? This is an interesting question. When distributions are made in stock, they are often treated as non-cash transactions. You would record the fair value of the stock at the time of distribution as a reduction in the investment account and recognize it as a distribution to investors. This can get tricky, so ensuring that you have a clear understanding of the terms of the distribution is essential. Now, what is a clawback provision and how is it handled in fund accounting? A clawback provision is a mechanism that allows investors to reclaim distributions if the fund doesn't meet certain performance thresholds. In fund accounting, you would need to track these provisions carefully and make adjustments to the investor's capital accounts as necessary. It's all about maintaining fairness and transparency with your investors. How do you manage investor reporting and communication in private equity fund accounting? Clear and consistent communication is key. You want to provide your investors with regular updates on fund performance, valuations, and any significant changes in the portfolio. Using a combination of detailed reports and personal communication can help build strong relationships with your investors. Remember, they're entrusting you with their money, so keeping them in the loop is crucial. What is a catch-up clause in private equity and how does it work? A catch-up clause is typically part of the profit-sharing arrangement in a fund. It allows the fund manager to catch up on their share of profits after the limited partners have received their preferred return. This means that once the preferred return is met, the fund manager can receive a larger portion of the profits until they reach a specified percentage. It's important to understand how this impacts the overall distribution process and to communicate this clearly to your investors. Now let's talk about fees. How are fees like transaction fees, monitoring fees, and break fees accounted for in private equity funds? Fees can be a bit of a maze. Generally, transaction fees are recognized as income when the related services are performed. Monitoring fees are typically charged annually and can be recognized over the period they cover. Break fees, on the other hand, might be associated with a specific event, like a failed transaction. It's crucial to have clear policies in place to ensure that all fees are accounted for accurately and transparently. What are the tax implications of private equity investments and how do you account for them? Tax implications can vary significantly based on the structure of the fund and the jurisdiction. Generally, private equity funds are structured as pass-through entities, meaning that income is passed on to investors and taxed at their individual rates. You'll need to keep meticulous records of each investor's share of income, losses, and distributions to ensure that tax reporting is accurate. Consulting with tax professionals can help you navigate this complex area. How do private equity funds typically structure their investments in terms of equity and debt? The structure can vary widely based on the investment strategy and the specific deal. Generally, private equity funds will use a mix of equity and debt to optimize their capital structure. Equity provides ownership and potential returns, while debt can enhance returns through leverage. It's important to analyze each investment's risk and return profile to determine the optimal structure. Now let's discuss how you prepare for audits in private equity fund accounting. Audits can be daunting, but with the right preparation, they can go smoothly. Start by ensuring that all your documentation is in order. This includes financial statements, investor agreements, and valuation reports. Conducting internal reviews and reconciliations ahead of time can help identify any discrepancies. Additionally, maintaining open lines of communication with your auditors can facilitate a smoother process. What is the importance of subscription documents and limited partnership agreements, LPAs, in private equity accounting? Subscription documents and LPAs are foundational to the relationship between the fund and its investors. They outline the terms of the investment, including fees, distribution policies, and governance structures. In accounting, these documents are essential for understanding the rights and obligations of each party. You'll need to refer to them regularly to ensure compliance with the terms agreed upon. How do you manage cash flow forecasts and liquidity in a private equity fund? Managing cash flow and liquidity is crucial in private equity, especially since investments can be illiquid. Regularly updating your cash flow forecasts based on expected capital calls and distributions can help you maintain liquidity. It's also wise to have a buffer in place to handle unexpected expenses or delays in capital calls. Keeping a close eye on your fund's cash position will help you make informed decisions. What is the role of fund administrators in private equity accounting, and how do you work with them? Fund administrators play a vital role in private equity accounting. They handle many of the day-to-day accounting tasks, including bookkeeping, investor reporting, and compliance. Working closely with your fund administrator is essential for ensuring accuracy and efficiency. Establishing clear communication channels and expectations can help foster a strong working relationship. How do you ensure accuracy and consistency in investor capital account statements? Accuracy and consistency are paramount in capital account statements. Regular reconciliations and reviews of the statements against the underlying records can help catch any discrepancies. Using standardized templates and processes can also promote consistency. It's all about ensuring that your investors have a clear and accurate picture of their investments. What systems or software do you use for private equity fund accounting? The right software can make a world of difference in private equity accounting. Many firms use specialized fund accounting software that can handle the complexities of private equity transactions. These systems often include features for tracking investments, managing investor communications, and generating reports. It's important to choose a system that meets your specific needs and integrates well with your existing processes. Finally, how do you handle fund wind down and liquidation accounting in private equity? Wind down and liquidation accounting can be complex, as it involves distributing remaining assets to investors and settling any outstanding liabilities. You'll need to prepare detailed final financial statements and ensure that all distributions are made according to the terms outlined in the LPAs. Clear communication with your investors during this process is essential to maintain trust and transparency, and there you have it. A comprehensive overview of private equity fund accounting, covering key concepts, terminology, and accounting practices. Whether you're preparing for an interview or just looking to expand your knowledge, I hope this information helps you navigate the world of private equity with confidence. If you enjoyed this video, don't forget to check out our other technical interview videos on the channel. There's a treasure trove of knowledge waiting for you. Thanks for tuning in, and until next time, keep exploring the fascinating world of finance with Finance Kida.